Anywhere you look right now, it appears to be risk-off sentiment. The Nasdaq is down 12% year-to-date. The S&P 500 could fall below the 200-day moving average today, and the sell-off in Netflix persists after a 24% plunge on Friday. Let's dive into the market action with Evercore ISI Chief Equity, Derivatives, and Quantitative Strategist Julian Emanuel. Julian, always good to see you here. What is going on out there in the pre-market? What are you hearing?
Well, look, I think the first thing we have to do, Brian, is sort of step back and think about how rare 2021 was. In a typical year, you get at least one, perhaps as much as multiple 10% corrections. And if you look at the S&P, year to date, you're down a little over 7%. Obviously, that looks to build at the opening. But when you think about what we have on our plate, whether it's the Fed that's clearly talking hawkishly, geopolitical tension that has ratcheted up seemingly quite significantly in the last 72 hours, and frankly, reactions to earnings announcements that for the most part have been okay, but the market just not giving any due respect to companies that beat. You put that all together, and it's not a surprise that we're flat-footed and defensive into this meeting on Wednesday, the FOMC, that really is a volatility event in and of itself.
And speaking of volatility events, Julian, as I mentioned earlier, we are seeing VIX futures come down even while current VIX is quite elevated. And so what does that tell us? What would be a sign to you of sort of selling exhaustion or selling peak, or do you think we're not going to get it until after the meeting?
When the market is trading like this, Julie, to try and pinpoint exactly when it's going to come is really a very difficult undertaking, particularly when you look at the last few days. You go back to Thursday, you essentially had almost a 2% rally in the index to be followed by a 2% collapse and then a further 2% collapse the next day. So it's very difficult to gauge this. Our inclination would be that if you get any further fear, we're looking at the front, the cash VIX at 35. That's the time where, as a patient buyer of dips, which is what investors should be, is where you want to start adding to your positions.
Julian, is it really that bad out there? To see Netflix down 24% in a session, Roku down 33% year to date, is the next 6 to 8 months that bad for big tech that warrants these really large downdrafts in some household name tech stocks?
We don't necessarily think that it is, but you have to remember is that the valuations of some of these companies became very, very extended, both relative to the last year and relative to the longer term history of these types of names. And now all of a sudden we're in an environment where the Fed's going to be hiking at the short end. In all likelihood, the fact that inflation has been as persistent as it has been is going to keep the long end of yields moving higher. And all of that works against high multiple stocks. Now, do all of these stocks tend to be grouped together? They do at the moment. But what we learned last week was that if you miss on growth expectations in an economy where we think you could get GDP growth north of 4%, there will be absolutely no mercy whatsoever for your stock. And I think that's what we saw when the FANGs started reporting at the end of last week.
Are we watching a bubble burst in big cap tech?
I don't think so. This is not the same as 2000, simply because the valuations were not quite as extended in any shape or form, particularly in the leaders. What we've seen actually in a lot of ways, though, is the market rationally discounting profitless tech. Those stocks have been in a bear market for almost an entire year now. The question is that going to stabilize at some point? And rightly so, given where the Fed is in terms of monetary policy. What we've seen in the last few weeks is the spillover into names that we know are going to have good earnings when they report this week. It's just that the price reactions have been, lacking, to say the least.
Yeah, I think that's definitely an understatement. So Julian, you mentioned people should be coming in. I think the phrase you used is they should be cautiously buying on the dips. Where should they be buying? Should they buy the market overall? Should they be buying tech? Where should people be nibbling right now?
So we think that the environment has changed, and part of the change in the environment has caused this dislocation, the undue pressure on tech. If you think of the combination of an above trend above trend economic growth, higher interest rates, and persistently high inflation, which again is obviously feeding into where the Fed stance is moving, all of those militate for having a value bias. Financials, industrials. We also like healthcare. Energy has obviously been a good sector. You have to be prepared for volatility in a sector that volatile. But the value type stocks that really have not worked for almost a decade, to be frank, those are where we think the opportunities are going to lie in the year ahead.
Well, Julian, there's another thing that I don't think anybody considers to be value, perhaps, but it's fallen more than almost anything else. I'm talking about crypto, of course. And so I wonder what your thinking is on that asset class right now because of the heavy selling that we've seen. And I think amongst the things that are different in this crypto cycle is the sort of institutional interest in it. And so I don't know how that changes the dynamics on the way down and then maybe eventually on the way up.
So for us, if you go back, we have been fans of crypto. You have to own it, and particularly when you've had this kind of a pullback, you have to believe in the use case. You have to believe in the asset diversification case. I think the use case with the proliferation of NFTs and more transactiveness in general is starting to prove itself. These things take time. We also have to realize that it's very, very typical for crypto to have 50% pullbacks prior to the next major leg of the rally. And if you look at it basically going back to almost a year at this point, is that you've ranged between, call it 28,000 in the low and on Bitcoin to upwards of 65,000 on the high. Our view is that as the capital markets digest more hostile Fed, and as the winners and the losers in crypto begin to sort themselves out, as they should in a rational market, as we've seen happen to profitless tech over the last number of months, you're going to have a period of sideways indigestion between those two ranges, low to high, and then ultimately at some point later in the year, or perhaps 2023, we think you start the next leg higher based on the use case for crypto and the blockchain, of course.
Always appreciate your level-headed analysis. Julian Emanuel, Evercore ISI Chief Equity Derivatives and Quantitative Strategist. Good to see you. Have a good week.
Well, we know there is a severe chip shortage that has been affecting companies around the globe, and in particular here in the United States. The Commerce Department out with a survey that puts a little bit more data around that. There are only 5 days right now of inventory of key chips versus 40 days back in 2019. Let's talk a little bit about how the U.S. government is trying to address that. U.S. Commerce Secretary Gina Raimondo is with us right now. Secretary Raimondo, thank you so much for being with us. What really stood out to you from the survey that helped you better understand exactly what this problem looks like and how long it's going to last?
Thank you and good morning. The survey really confirmed for us in very great detail and in alarming detail what we already knew. We all know, every American knows we're struggling with the chip shortage. It's why you can't get your appliances in on time when you're redoing your house. It's why car prices are so much higher. It's why it's hard to find a new car or used car. The answer is not enough chips. So we all know this. What we learned in this exhaustive study is that the chip demand is up 20% relative to where it was a couple of years ago. And the factories making the chips are producing at their maximum limit. They're at more than 90% capacity. So the only solution is to build more facilities in the United States of America to make chips. And the 5 days of inventory that you referenced, that's an alarming statistic. And what it tells you is that we have no room for error. If there's a storm or a COVID outbreak, which takes a manufacturing facility anywhere in the world in the supply chain offline, that could cause massive disruptions here at home. So it just added a great deal of urgency to getting the CHIPS Act passed in the Congress so we can get to work making more chips in America.
Secretary, this morning we spoke with Ford CEO Jim Farley, and we asked him about the chip shortage. We'd love to get your reaction to what he told us about this.
We have the chip crisis going on at the same time, probably the biggest supply shock I've seen in my career. So all of it is happening at the same time. But I think the real encouraging thing is that Ford can develop great products where we do really naturally well. And we're being handsomely rewarded for focusing on our strengths.
Secretary, so what is the message to CEOs like Farley? Should they be hoarding the chips they could find? Should they be cutting back production? How could they navigate the situation?
Yes. So first of all, the word I heard was crisis. And I don't think that's an exaggeration. It is a crisis. Chips are unique in their importance. There are chips in everything you use, phones, cars, medical equipment. So it's a unique product, and the shortage is a crisis. Secondly, we need to make more chips in America. I think they should not be hoarding. There's no purpose in hoarding. That just distorts the market further and creates even more disruption. I will give credit to GM and Ford. They have actually reached out to semiconductor companies. In the case of Ford, they did a partnership with Global Foundries. They're trying to be creative, forging these partnerships with the chip makers. But really, at the end of the day, we need to make more chips. I'll give you a concrete example, and it relates to Jim Farley. The average electric vehicle, which of course is the future, takes 2,000 chips in one car. The average traditional non-electric vehicle is maybe 600 or 700 chips. So the demand is just going to continue to be off the charts. And short-term solutions like hoarding, like stockpiling, they don't get you anywhere. What we need is to make more chips in America.
And I know that you've been working very hard on that. Congress has been working on it as well. The Senate passed a bill that had some measures to increase semiconductor production in the U.S. The House working on something similar. What are the chances at this point of passage? I mean, we talk about crisis. We talk about the sort of acuity of the need right now. This is a longer term solution, to your point. Does that mean that there's not going to be enough of urgency and a push to actually get this through?
I think there is urgency. I have spoken to dozens of lawmakers this year, in the new year, Republicans and Democrats, House and Senate. There is urgency. There is broad bipartisan agreement and recognition that this is a problem that needs solving and we need action right away. I am hopeful that the House will have this bill on the floor next week when they return, and that they will swiftly, move to passage so that we can hash out the differences as between the House and the Senate. There are differences. This is hard work, of course, but the fundamentals of this bill have broad bipartisan support. And you hear it yourself. You hear, retired generals, national security folks saying this must happen. It's untenable that we purchase the vast majority of the most sophisticated chips from Taiwan, from one company in Taiwan. Many generals and leaders in the military have been ringing the alarm bell on that. By the same token, you have CEOs of every major company in America saying their business depends on chips. So this is definitely not a Democrat issue, Republican issue. It reminds me a lot of the bipartisan infrastructure package. Yes, there were differences, but what what the sides agree on, I believe, outweighs what they disagree on.
Secretary, how much is the chip supply shortage, from your vantage point, impacting the U.S. labor market? Because when you talk to folks like Farley, his contention is that this is not having a bill like this passed is hurting the creation of new jobs, but also hurting the impact of jobs of the future, especially in the tech space.
There's no question that is true. By the way, jobs of today, both Farley and Mary Barra, many auto companies have had to lay off or furlough thousands of workers because they couldn't get their hands on enough chips. I can't even estimate how many cars and trucks right now in the United States of America are, partially assembled and can't be fully assembled because of chips. And so that means workers are put out of work. Not to mention, as you say, the potential job creation. I was in Ohio on Friday. Intel announced a new manufacturing facility for chips in Ohio. That one facility, they estimate, will create over 10,000 jobs. So the job creation element of this package of substantially enhancing manufacturing in America is gigantic.
Secretary, as you alluded to, there is bipartisan support for these types of measures, that type of U.S. manufacturing. Not as much for the president's Build Back Better package, the next tranche of aid for the economy. And I know a number of CEOs, including Jim Farley, are set to meet at the White House today. I believe you'll be at that meeting as well. What's going to be the message of the administration? And are you hopeful that getting these business leaders on board can also help get, maybe it's a bridge too far to say Republicans on board, but maybe some of the intransigent Democrats on board at least?
I hope so. I hope that members of Congress will listen to these business leaders. As you just put up on the screen, this is a range of business leaders across industry, software, tech, financial services, industrials, automakers, and they all believe what we know and what the president knows is that the investments which the president is proposing in Build Back Better are good for the economy, will create jobs, will enable people to go back to work, will expand the labor force, and will ultimately enhance American productivity. I give these CEOs a lot of credit. They're coming forward and saying, pass Build Back Better because our businesses need these investments. Whether it's investments in childcare so women can work and be productive, or investments in climate, which creates jobs and saves the planet, or investments in job training, which will enable the workforce of the future. These are investments which are good for business and good for workers. And so often I hear Build Back Better miscategorized as a quote unquote social spending bill. Well, you don't often get a dozen or half a dozen leading CEOs behind quote unquote social spending bill. What you're going to hear today is this is good for the economy. So let's get it done. And let's build and enhance the productive capacity of our economy and create jobs while we do it.
Secretary Raimondo, and I know you've talked in the past about its help in making the U.S. more competitive as well. So I'm sure that will be part of the discussion. Thanks so much for being here. Good to talk to you. Secretary Gina Raimondo, the U.S. Secretary of Commerce. Thanks so much.
Welcome back to Yahoo Finance Live, everyone. Taking a look at shares of Microsoft here on the day as we've got big news for big tech. Microsoft reporting its fiscal Q2 earnings, beating analyst revenue expectations by almost $1 billion. The tech giant also announced its cloud services Azure revenue that jumped 46%. That's down a bit from its 50% jump in Q1. For more on this, we welcome in Piper Sandler equity research analyst Brent Bracelin joining us today. Brent, let's dive right into this because you actually believe that Microsoft Azure could double within 3 years. So where do you believe the business could continue to drive increased adoption leading up to and en route to reaching $80 billion is the number that you've got?
Yeah, so if you think about the opportunity in cloud, we see an incremental $1 trillion of revenue. The overall enterprise stack is about $2 trillion. If you take the 100 largest cloud players, We're about 290 billion. So that puts cloud penetration at about 15%, with Microsoft being the cloud king here. They have about 28% market share. That's the highest market share out of all the cloud vendors. But there's still a long runway to help these large enterprises transform their models, digitize their businesses, and really run more and more of their applications on Microsoft itself. And so, yes, the crown jewel for Microsoft is Azure. It's 20% of the business. But as we cross over that $40 billion threshold this quarter, you can see that as it becomes a bigger part of the Microsoft business, grows from 40 to 80 billion, that's going to change the growth trajectory of the business. Most importantly is that not only is Azure changing the growth trajectory of Microsoft's business overall with that mix shift to Azure, but it's also driving incremental profitability. This is a company that generated 43% operating margins, even with all of the investments they're making in the cloud.
Brent, even with that said, investors initially yesterday, when those numbers came out, weren't exactly wowed. And we're talking about Azure with, as we're showing, 46% revenue growth. And yet the expectation seemed to be that things would go even higher. Essentially, Microsoft just matched the expectations that were out there. And I wonder what you think this says about just how jittery the tech trade is. Microsoft shares didn't actually bounce back until we heard from CFO Amy Hood, who said, look, the demand is still really strong.
Yeah, I mean, listen, there's hypersensitivity to the cloud group right now. This is a group that's down about 50% since from the highs in November. We're down 20%. The whole Cloud 100, it's down 20% year to date. So a lot of concern around the sustainability of cloud growth. That's why there's hypersensitivity when Azure downticked from 48% FX adjusted growth last quarter, 46% growth this quarter. There was some initial reaction and concern that may be the beginning of a slowdown. Microsoft clarified they actually think Azure is going to re-accelerate. More importantly, leading indicators for the cloud business, their CapEx spend accelerated, their bookings accelerated. So there are other inputs that people didn't see initially that give people confidence that, hey, this cloud transition is still very, very strong. Demand signals are very strong across the whole entire stack of Microsoft products.
We're also on the screen here taking a look at Xbox content and services revenue. That was up by about 10%. And it was going to be noteworthy what the executives had to say about this most recent blockbuster acquisition of Activision Blizzard. Of course, it still needs to get through in entirety. However, as of right now, are you impressed by what the company has been signaling around what they're intending to do, how immediately accretive it could be in the future, and what type of contribution that it could make to margins in the future too, because it's margins from the cloud business that allows them to continue to make some very large strategic acquisitions such as this?
It's interesting. Most people give Microsoft a lot of credit for their commercial cloud business. That's the growth engine of the business. But Microsoft still has a pretty impressive consumer business. It's small. I look at Activision Blizzard as really a strategy around consumer and driving share gain opportunities beyond just cloud, but also now on the consumer side. That's a big content. Microsoft's generating close to $70 billion a year in free cash flow. So essentially able to pay for the entire acquisition of Activision Blizzard with 1 year of cash flow. So I think it's a better use of cash than Microsoft sitting on $120 billion of cash today. And I do think it's a really strategic asset as you think about them getting into the content side on the consumer space, particularly as you think about different ways to monetize the content that Activision Blizzard King have, be it, in gaming today or the new metaverse market. So content's king. They're getting in that consumer space, and I'm certainly constructive on the combination here.
And Brent, you've got a price target of $352 a share. We're right under that, about $300. What do you think is the biggest risk right now for the company? I mean, now that we're seeing investors sort of digest the numbers with the commentary got on the call. Certainly the outlook is positive, but what's the biggest thing that could potentially derail that?
Listen, there's lots of things to be worried about as we think about external factors. But ultimately, we believe as you think out beyond some of the external factors, even going back to 2004 to 2006, this concern around FOMC rate hikes, the FOMC raised rates 17 times from 1.25% to 5.25% between 2004 and 2006. And guess what companies and stocks did really well? High growth, high tech names. So listen, I think there's a lot of concerns. There's a lot of issues about Microsoft as a large cap was up over 50% last year into basically November before the sell-off. And so I think we're going through kind of this fundamental growing into the multiple. Valuation is still a big risk. But as we think about large cap software names, Microsoft is one of the best names in our coverage list here that has very durable growth, irrespective of some of these external factors that are certainly going to weigh in valuation.
Brent Bracelin, Piper Sandler Equity Research Analyst, Cloud Software and Analytics. Good to get your insight today. Appreciate you stopping by.
Dow Inc. is out with better than expected sales and profits for its most recent quarter. The upside results come despite supply chain disruptions continuing to weigh on industrial giants like Dow. Joining us for a First on Yahoo Finance interview is Dow President and CFO Howard Ungerleider. Howard, always nice to see you here. There's a lot of volatility out there in the markets and the economy right now, to say the very least. From your vantage point, what grade would you put on the health of the industrial economy ahead of really what might be some interest rate hikes later this year?
Yeah, well, good morning, Brian. It's great to be with you and Julie as always. I would say, look, if I could just start with the quarter, it was a triple beat. We beat on the top line. We beat on the bottom line. We are entering as Dow our 125th year as a company. It was record earnings and record cash flow full year 2021. To your question on the outlook and growth, look, our view is the economy is doing well. You saw the GDP numbers out earlier today in the US. When you look at your predictions for 2022, whether it's GDP growth or industrial production or manufacturing output or consumer spending, all of those estimates, depending on which third party you're talking to, are ranging between +4% and +5%. Growth. You also, when you look at the value chains, whether it's furniture or automotive or appliances, or even if you go into your grocery store, you will see shelves that are nowhere close to being stocked. And so you also have, I think the number is more than $5 trillion of excess savings that have accumulated in consumers' bank accounts, essentially, through the pandemic. So there's a lot of pent up demand. And I think that's why you're seeing those inflationary numbers and the raw material costs increase. But that does bode well for continued economic growth through 2022.
And Howard, let's get into the nitty gritty a little bit in your numbers and what that tells us about what you were just saying. So in your statement, you talk about local prices up 39%. And if you would, just explain to me, does that mean what you're charging or what you're being charged? And at the same time...
Yeah, go ahead.
Please.
I was just going to say local price is the price that we are charging in local currency, right? So it doesn't have the translation effect.
Gotcha. So local pricing up 39%, volume down 4%, which I think is sort of a snapshot of writ large what we are seeing more broadly. That volume down 4%, is that just because of supply constraints? Are you seeing any kind of hit to demand, or is demand still very robust?
Demand is still very robust, Julie. I would say that impact on lower volume is really because of some planned turnaround activity. We had to do maintenance at our facilities. We had one large unplanned outage in the Netherlands that also impacted our ability to ship, but also the logistics and the supply chain constraints that we talked about. Those are all impacting that volume number. As you move forward into 2022, you should expect positive volume growth from Dow. One of the big changes next year versus last year was the winter storm. If you recall, Winter Storm Uri knocked out really the entire industry's production for almost 30 days in the state of Texas. And the state of Texas is a large chunk of the U.S. petrochemical industry. So hopefully, touch wood, that will not recur. And so we will have more opportunity to be able to ship product. The other thing that we're seeing is marine pack cargo is improving. That was probably one of the biggest issues that we had last year. There were two strong months. March of last year was a strong month, and then the next strongest month was December. So as we went through the fourth quarter, that marine pack cargo constraints was starting to ease, and we should see that continuing to ease as we head into and through 2022.
Has inflation peaked for Dow?
I don't, it's hard to predict, Brian, but I would say, look, I think inflation, I've been of the view that inflation was not transitory, even going back maybe, I think when we talked last on the New York Stock Exchange. You're going to see inflation continue here at least through the first half of the year. We'll see. It's a little bit too hard to call what the back half will look like. But our costs are up. When you look at our raw material costs or our logistics costs or our energy costs, our costs in the fourth quarter were up more than 20%. And I don't see that easing, especially as you look at natural gas prices that are elevated right now. And you've got oil. Brent touched 90 yesterday, and there's just not enough supply of new barrels of oil versus the demand growth that people are seeing because of the GDP and the manufacturing growth output that people are expecting.
So Howard, just quickly, what does that mean for you guys raising your prices in 2022? How much do you think that you're going to continue to see that?
So inflation for Dow, I would say, it's a tale of 2 points. In the short run, inflation hurts everyone because you're not able to capture all of the pricing that you need in order to keep pace from a margin perspective. But over the medium term, Dow historically has done very well with an inflationary environment and an environment that has rates moving up. We tend to outperform in those periods of time because you're able to drive higher pricing, which typically allows you to at least keep pace with your margin growth as your volume is growing and potentially be able to expand it over time.
Well, the market seems to agree with you, at least in the early going. Shares of Dow up about close to 3% in the pre-market. Dow President, CFO, Howard Ungerleider, always good to see you. We'll talk to you soon.
Great to see you. Thank you.
Levi Strauss Co. reported multi-decade record revenues and profitability during its most recent quarter. For more on the demand for denim, we welcome in Hermit Singh, who is the Executive Vice President and CFO of Levi Strauss Co., alongside Yahoo Finance's Brian Sozzi. And let's dive right into this. Hermit, thanks for taking the time first and foremost here on the day. When we talk about these multi-decade record revenues, it certainly seems like, based on what you've reported, those net revenues even flat to fiscal year 2019, the last pre-pandemic marker here. So what is driving some of the reoccurrence in getting back to some of those pre-pandemic levels?
Well, good morning, Brad and Brian. Thank you for having me. And even though late, I said Happy New Year. First, I'm really proud of what our teams have achieved in delivering the multi-decade record revenue and profits you referred to. And it's, they've done it by leading through our values. The company and the brand are the strongest in decades, and our performance has sequentially improved, and we've had a strong holiday season. We bought Beyond Yoga. I'm wearing their joggers, and that's well integrated. They've started the year really strong. Going into the question of confidence, because we're realistic as we think about the future, a couple of things that are working for us. One, the casualization trend continues to accelerate. The denim cycle, which we kind of started by introducing the looser, baggier fits, is really taking shape. The denim category is growing faster than apparel. Our market share in 2021 globally was actually up 0.3 of a point. Our share in the US for women's, as well as the younger generation, is actually growing. And so, it's a fun fact, but waist sizes in the US, 40% of the waist sizes have changed during the pandemic. And what is better than having, the new, fresher styles from Levi's or from Dockers or from Beyond Yoga. So, I think those are the pieces that I think we feel really good about. We've also, much has been written about, I would say, the consumer. We're looking at all trends, whether it's credit card data, economic forecast. And our view is the consumer is strong despite inflation, despite supply chain issues that people talk about.
Hermit, good to see you again. You've been talking really the past year or throughout the pandemic on people buying more jeans because their waists their waist sizes continue to fluctuate throughout the pandemic. What sizes are they buying right now? What styles are they shopping for?
Yeah, so I'm not going to get into how many sizes went up and what percentage went down, but it's both up and down, men and women. They're buying the looser, baggier fit. They're buying, 501s were up. Our bottoms, both men's and women's, is growing. They're buying, our tops. I mean, I'm wearing the trucker jacket. Go 49ers. They've converted a cricket fan into a football fan. But generally, as the people are getting more casual, they want comfortable clothes, and what better than having more Levi's in your closet?
Certainly. And so as we're all trying to figure out what our wardrobes look like, as we're trying to re-embrace society and things are opening up more socially, at least here, it certainly does come at a time where there is even more shopping digitally as well. Would love to break down what you're seeing, particularly in that direct-to-consumer segment that accounts for e-commerce, and where you're making even more investments, given that you have this mix of direct-to-consumer, which encompasses your stores plus online, but you also have that wholesale and retail partnerships as well side of the business?
Yeah, no, it's a great question. Direct to consumer is one of our strategic choices, and growing that is important. About a decade ago, when Chip joined, the direct to consumer business was about a fifth of our business. We ended 21 at about 36%. In 22, we're going to grow that to about 40, and we're headed towards 60% of our total business being direct-to-consumer. Direct-to-consumer has two major components. There are stores. We continue to open stores. We continue to open stores during the pandemic. We've announced plans to open another 100 doors. A lot in the US, for example, smaller footprint. They really work, as well as growing our digital e-commerce business, which has probably doubled, since the pandemic. Both e-commerce and our stores are accretive for gross margin. And that's why when we guided our gross margin, we actually guided gross margins will continue to grow. The more important thing is it allows us to directly engage with the consumer as we roll out and expand our loyalty program. We have an app. We're expanding the app. We have an app. Our app now is in 9 countries. We want to take it to about 15 countries by the end of the year. And that's a way to really engage with the younger consumer. So we feel really good about where we are and where we're headed. And we're bucking the trend by opening stores and, continue to invest in growing e-commerce. To your point about, how does that look? Our return on invested capital is the highest it's been in a decade at 26%. So, we are not only, and I say this, the CFO's dream, when you're spending more capital and at the same time increasing returns. And it's been great.
Hermit, slight change from the last time we spoke on how you report or break out sales for Dockers. Now, is that brand back on the sales block, and are you open to fielding offers for it?
No, in fact, Dockers is here to stay. Dockers had a phenomenal year in 2021. We actually carved out Dockers from Levi's. As the company builds a portfolio of brands, we just acquired Beyond Yoga. The reason we split Dockers out was because, we bought Beyond Yoga. We have created a segment called Other Brands, which is Dockers and Beyond Yoga. And we wanted to keep it separate from Levi's. It's a dedicated team in Dockers, a dedicated team in Beyond Yoga, both reporting into the CEO. And we run it like any private equity. They have a certain amount of capital. They're measured on how they perform. And more importantly, as we've broken it out, the strength of the Levi's brand is really, something that really comes out. So, Dockers, we're long on Dockers. They are the leaders in casual pants, and as the world casualizes, we think Dockers has, long runway for growth.
Hermit, such a pleasure to have this conversation with you today. We didn't even get your take on jorts, but we'll have to save that for another time. Great to have you here. That's Hermit Singh, who is the Levi Strauss Co. Executive Vice President and CFO, plus Yahoo Finance's own Brian Sozzi as well, jumping in on the conversation.
Well, Stifel Financial earlier this week revealed its 26th straight year of record net revenue, 5th consecutive year of record earnings as well. Let's bring in Stifel Chairman and CEO Ron Kruszewski. Ron, good to see you. Thanks for being here. It's always a pleasure to talk to you. I want to start actually not on the earnings, but perhaps future earnings implications from what we're seeing with interest rates. That's because both Brian and I were kind of surprised today. Bank of America coming out and saying we could see as many as 7 rate increases from the Fed this year. You guys saw an increase in net interest income last quarter, but you've got other stuff that might offset that from rising rates. So talk me through the effect on your business if there were, say, 7 rate increases.
Well, we did say that with 4 rate increases, basically 100 basis point shock today to interest rates. If it happened today, our earnings would be up almost $250 million. And so we are, as an organization, we're very, as they say in our business, asset sensitive. So rising rates would be very good for Stifel, very good. On the other hand, 7 rate increases may also shock the economy, and and that could possibly even cause a recession. So that could have some other impacts on in our investment banking and on capital raising. But overall, rising rates, as long as they occur in a measured and maybe communicated manner, would be very good for Stifel.
And Ron, Stifel works very closely with a lot of just companies in the middle area of banking, or however you want to look at it. What are they telling you right now? Is the economy so strong that it could handle 7 rate hikes, or even 5 or 6?
I think, first of all, today, while demand is huge, that's what we're understanding, is that there's been so much money put into this economy, both fiscal and monetary, through QE and low interest rates, that demand is great, and businesses are struggling with meeting demand and keeping people at work. And the whole combination of the pandemic and everything has made it hard on business to keep up with demand. And of course, what they're doing is raising prices. I mean, this is economics 101. So, I believe that the economy needs to be cooled a little bit so that supply can catch up with demand. We all learned that. I did 40 years ago. I don't think it's changed.
No, it has not changed. I can confirm that. I remember learning that myself way back when. But let's focus on the business for a second, because it was another quarter of strength for Stifel in investment banking. Why do you continue to see the strength?
We actually, Brian, and I think you and I talked about this, we set out really right after the financial crisis in 2010. We felt that with what happened in the market, with Merrill being acquired by B of A, with the unfortunate circumstance with Lehman, with Bear Stearns going into JP Morgan, we believed that there was a tremendous opportunity for a firm like Stifel, that was a bank and an investment bank and a wealth manager, to grow into the void that was left for middle market companies. And we went from being back then, a very focused middle market firm to a global firm that can handle all kinds of business, but again, for companies that are in the middle market. And that's why we've grown as fast as we have, is that the market opportunity for us is so great, and we've simply taken advantage of it.
And speaking of which, I was taken on your call. You mentioned several times that you are a growth company, that Stifel is a growth company, which is reflected in that advance that we've seen in the shares, not just over the past year, but over the past several years. That was your third consecutive year of double-digit growth in the stock. But should you be careful what you wish for? In other words, growth stocks are getting smacked right now. You guys are off about 7% from your highs, so definitely not as acute as we've seen in software names, for example. But are you worried at all about slowing momentum because of how the market is viewing those kinds of companies right now?
Well, look, I say we're a growth stock. We're also a very consistent company. I would challenge you to find another investment bank that's had 26 consecutive years of record revenue. So I think we're consistent in growth. But specifically to your question, I mean, I would worry about it if my PE ratio was in sky high, and that's what happens to big growth companies that have huge PEs. As rates go up, they get, their stock prices come down. I mean, our PE ratio's, basically under 10. So even though I like to say I'm a growth company, the market has not given us the multiple that certainly I believe we deserve for the kind of growth that we've displayed. So yeah, I hear you. Be careful what you wish for, but we've been a growth company, and I think the market will recognize it at some point.
How hard is it, Ron, to keep the talent you have when you have first or second year associates pulling in $150,000 base and being promised all sorts of bonuses and perks?
We're a competitive firm. We're going to pay people competitively. I think that the difference is it's an overused word, Brian, but it's our culture, right? People want to work in an organization that's growth oriented. We're a very performance based shop, and if you do well and you perform well, you're going to get recognized. And so, of course, we feel the competitive pressures, but, I believe that people want to work at a successful, growing organization. And that helps. It's not all just about, what you take home in your paycheck, although that is a big part of it. I don't mean to suggest that it's not. But if you work here, people work here like it. And that matters.
Does it matter, Ron, too, just staying on the worker aspect, that workers in an investment bank are back in the office, that trading desk is as full? As the CEO, do you want to see them back in there full time, given that we are still in the pandemic?
Yeah, Brian, it makes me feel like I'm some, guy that maybe doesn't get it in terms of the new work environment. I certainly, and we as a company, will embrace and understand remote work when necessary and when we can accommodate certain circumstances. But I have to tell you, I've been in this business a long time, and we are an on-the-job learning company. And our young people learn by being together with other people. And I've seen it, the amount of collaboration, the amount of creativity, the productivity that comes together from being together is unmatched. And so while I'll protect our employees and be very, very mindful of the whole health situation, at the end of the day, I know that we will be a better firm if our people are together and collaborating together. And again, I think people miss being at work. And so it's really not that controversial in our shop. People want to get back together.
Amen, Ron. If the camera could pan around this room, you will see that despite the background, I'm not in the studio. I am rather on the third floor of my house. Ron, good to see you. And I wish
if you panned around here, you would see that I am in my office and there are people here. So good to see you too. Okay.
Good to see you.
Yes, but it is you are luckier than I today. Ron Kraszewski, Stifel CEO and Chairman. Great to catch up with you. Thanks for your time today.